Hello, everyone, and welcome back to the Hypernest podcast. Today, I have the great pleasure of being with the co-founder of Stocks, Toby, and we're going to discuss about tokenization of stocks. That is actually the new cool kid in the game. We just crossed 1.8 billion of on-chain presence of stocks. Therefore, we moved from being a science experiments to mass adoption. And the interest from institutions, regulators like the SEC, tell a very clear story. We're tokenizing stocks. That's the future. And today we're going to discuss about the details of it, the complexity of it, the intricacy of this category of real-world assets. But before we get into the details, I want to ask Toby, how did you get into stocks? And most of all, how stocks entered in the tokenization of equities that, by the way, it's kind of difficult to tokenize.
Yeah, so my personal journey into this space started in 2017 and then started building in Web3 in my final year of uni. So whilst I was doing uni, I was managing 10 developers, waking up at 3 a.m. to speak to them across different places in the world. Rode a couple of those ups and downs in the cycle, met some amazing people along the way. Which is the team that we have now. And around 2 years ago, we were discussing how to leverage this DEX that the team had made. It's probably one of the most advanced DEX that exists in DeFi today. And we were discussing ways to leverage it. And we met up in Sark, this small little island. I'm from Guernsey, this small little island. There are like 600 people on there. And we said, why don't we go for the biggest opportunity that exists? Tokenizing publicly traded assets is one of the largest markets in the world. Why can't it be us? So from that point, we decided to go for that goal. Then it wasn't so clear on how you could do this regulatorily wise. It wasn't even clear if it would even be accepted. Since then, things have changed massively. Our assets themselves are regulated securities out of the EU. So we've all got that cleared and done. And yeah, the opportunity is looking like it's coming to be real. You know, all the big banks, all the big institutions, they're now all looking and talking about this space. So it's been a huge sort of journey to get here.
And congratulations on predicting the future. When we met the first time, if I remember correctly, there were 200K of stocks on chain, or like, there were a lot of people saying just it's not going to happen. And now it seems to be one of the most interesting assets being tokenized, probably the most interesting by far. Okay, that's great. That's super interesting. And I think the stocks started as tokenizing several types of shares, and now you're moving a little bit also toward being the infrastructure to provide others the whole journey for tokenizing their stocks, right? How did you move from one to another, or how are you complementing these two worlds?
Yeah, it goes. So when we started looking into the models of how people were tokenizing, it became quite clear to us what we needed to do and how we needed to set up our claims and infrastructure.
Mm-hmm.
So when you hold tokens of ours, the claim that you have is a redeemable claim to the underlying asset one for one. It seems really simple and quite an obvious way to think about it, but when you look at a lot of competitors and you look at the claims that you provided, that's not actually what you have. So we went down this route. We created our own infrastructure, our own prospectus, our own claim rights. And that idea of redeemability against a share can be used extremely broadly. Share as a financial term does not peg you into any specific asset class. It can be, extremely broad, a share of anything, right? So once we had built this infrastructure quite quickly through meeting other people building in the ecosystem, people are coming across the same issues of firstly, how do I go about this? What am I even creating as a thing, right? What is a tokenized asset? And there's no real right answer yet. People are exploring different models. As we explained ours, people saw the value in it. And then two, the legal and corporate infrastructure that you need to set up to be able to make this a possibility costs. It requires money, it requires time, it requires personnel in certain jurisdictions to be able to do that. And across meeting all of those teams, they had a demand for those things, right? So it became quite an obvious split of being able to solve people's problems for them.
That's fantastic and makes sense. But when you say tokenizing shares, basically tokenizing equities, it's kind of a broad range. It's kind of encompass a broad range of assets. Are you also considering your infrastructure available for other type of assets beyond the equities?
So how our legal infrastructure is split up is that we have an issuing entity called S01 Issuer.
Mhm.
We then have stocks, DEX, which is out of the BVI, which creates the trading infrastructure that puts it on chain. It's the main name behind the brand, and its core focus is on equities, publicly traded assets, ETFs.
Mhm.
S1 Issuer can then, as I explained, do a bit of a white labeled service where anybody can come to them and say, hey, I want to tokenize X, Y, and Z. So we're speaking with a number of partners from anything to tokenizing boats, tokenizing oil, tokenizing real estate. So it's a very broad number of conversations that we are having and we can have because the way that we've set up our claims prospectus legal infrastructure is very broad as opposed to creating a whole prospectus all around using terminology that puts you in a hole of saying just equities.
That makes a lot of sense. Okay, so now let's then dig deeper on the first part of your explanation. So the claim on the underlying one-to-one. I think it's very important because as we know, there is a broad spectrum of possibility. So when we see a tokenized Apple stocks, on one side it can be a derivative tracking, just price, and IOU, so I own you, or it can be more on the opposite side of the spectrum, more a claim on the underlying, or it can be even, directly a tokenized stock certificate. So, and from, let's say, from the left side, Robinhood tokenized stocks, on the right side, more superstate and securitized, and so on and so forth. So, where is stocks in this spectrum?
So I think it's key to understand traditionally if you have an interactive brokers account or a Robinhood account, what do you actually hold?
Uh-huh.
You don't have a share with your name on it. You don't have full ownership. What you have is a string of contractual claims
Uh-huh.
back to the core ledger held at the DTC. So okay, something from like Robinhood to their custody broker back to the DTC. So a string of claims, and what you have is a security entitlement.
Uh-huh.
Those string of claims provide you rights to the real thing. What our claim provides you is, again, it's a different asset, it's a different security, but it's redeemable for the underlying. So it's still a string of claims back to the same exact thing, right? So it's important to understand that even with these different stopgaps, it all points back to the underlying share. Then in comparison, when you look at Ondo, when you look at X stocks,
Uh-huh.
what they're actually providing you with is a claim against a monetary value. So
Uh-huh.
you can't go to them and say, I want the underlying share. That's, what my legal claim will end up in. They're saying, no, it ends up in a monetary value. Why this is dangerous is because you're now bringing trading. So when you make that claim, a trade is made. And that trading activity sits in the same stack as custody. Traditionally, you wouldn't allow a custody bank structure be at risk of any trading structures. Those things are purely separated. If you went to a BNY custody account, there's no way in hell that that custody account could be at risk from any trading activity across anything else that BNY does.
Uh-huh.
It's not acceptable. But in these new bridges that are being set up onto an X stock, that's what the whole premise is built around. So when you go to them and you say, look, here's my Tesla share, they will come back and they will give you a monetary value against that. So the claims are different with us. It's a string back to the actual share, which is something that you're quite used to when you're in a Robinhood or Interactive Brokers account. With this, Ondo and X stocks, you're trading against monetary values. So yeah.
Okay, but would you say there is also a difference related to what I'm on in terms of, for example, voting rights, dividends, and so on and so forth. Because on one side, the way you're describing it, I am just exposed to the pricing. But if I have a claim on the underlying, am I exposed also to voting rights and everything else?
So across Ondo and X stocks, they don't explicitly say that you have these rights. And it's the same with us because this still needs to be treated as a separate security, but we still do those actions. So we still provide you with dividends. Voting rights will be coming out as well, so you can vote on this token and we'll be putting it forwards. Ondo and Xtox, as I know, have been paying out dividends, and there's a core reason in Ondo's token design that it's actually a token that will drift in price as they reinvest dividends back into that price. So over a year, Ondo's token price, the actual stock price, are going to be different as they sort of have this effect as dividends get wrapped back in. But explicitly in the terms, those aren't made explicit to users because there needs to be some sort of separation between, is this actually a separate asset or is it still the underlying share?
Mm-hmm. So, okay, so the way how some of the stocks are, tokenized stocks are solving the dividends, parties are investing in it, some similar to when we wrap some like WSTAT, right? So when we wrap some yielding token that represent validators in a blockchain, something like that. Okay, and how voting rights are actually structured. So do I have voting rights if I have your stocks, or I don't? Or and in other situation, do I have voting rights, or it's just something that most of the time is off the table if I don't go through KYC, KYP?
So, and just to finish on those dividend points when you mentioned about wrapped tokens, how we set our tokens up is we have the tokenized share. So it's a T NVIDIA, T Apple. So the terminology that is being used across DeFi. And then we have the wrapped version as well. So WT NVIDIA, WT Apple. And that allows users to have two options where if they hold just the tokenized version, they can get cash dividends paid out towards them. Or if you want the wrapped version, so it can be used across DeFi, which is the one that we distribute, used in pools, used in lending, it then works as well. Answering the voting questions, I haven't seen anybody provide voting to their users. When making this security that we have, Ondo and Xstocks have, it needs to not look exactly like the underlying share. There needs to be some differentiation. So in the terms, it's not explicit that you have these voting rights, and it's the same with us. We are looking at solutions to try do it where we can just forward them on, aggregate the votes, but explicitly in no one's terms across the industry have I seen you specifically get voting rights.
I see. What about the custody? So we have seen several structure, also legal structure for the custody, and in particular, the difficult question is what happens if there is a bankruptcy remoteness procedure. So what would happen in your situation? Do I still own the stocks in case your company go bankrupt? Can I claim it, or this is not possible?
So looking at insolvency, for us, our issuing entity is set up as an SPV, so there's no additional risks or creditors that could be put against that institution. So event of insolvency is highly unlikely. In the event of an unwind, what would happen is the users would redeem for the underlying share, and that could be sent to any of their own brokerages. Or they could also sell online to market makers who could then redeem themselves, right? So the whole point of how our bridge works is that using the like-for-like transaction is when anything ever goes wrong, when market activity goes out of skew, somebody who's ever's holding these shares can always go back and get the same thing, right? So let's say if it's a non-KYC'd individual who's acting on a DEX, and an unwind process starts to happen, they don't need to go and do KYC to interact with our issuing entity to then go and receive the underlying shares. We have market makers that work around us within this bridge who they can trade with. The market maker can get the token and swap for it for the underlying share. So that's how that would sort of play out in that event. But we've taken corporate structure risk, corporate structure setup to make sure that that risk is highly minimized.
I see. Yeah, I see your point. And in terms of regulatory jurisdiction, so you mentioned being highly active in Europe. So does it mean that people from the US cannot use your tokenized stocks, or you're now considering expanding to the jurisdictions according to the licenses that you have? So how would it work in general?
I think it's more about how your users are accessing. So for us, we lean on decentralization quite heavily. Stocks is trying to build on-chain markets, build on-chain liquidity, purely work with decentralized protocols, and try to become the on-chain winner of liquidity. Tokens can go anywhere once they're on-chain, and a US individual holding a wallet can very easily go onto a DEX and buy that token without them ever coming into interaction with any of our entities directly, right? They just end up holding the token, and that's entirely possible for US people.
Okay, so there isn't a specific, well, of course, because they're in a public blockchain. I mean, probably also the protocol where the stocks, the tokenized stocks live are not geofenced very often, so potentially everyone can have access to it. But if you need to explain step by step how the tokenization process works, for example, who is the custodian, right? So who is in custody? Who is the register, and so on and so forth. So how does it work, your specific infrastructure?
So our tokenization stack aims to split up governance. So tokenization as a process with competitors is managed purely by themselves and in a bit of a black box. What we've done is look at the tokenization process and say, right, how can we split this up? How can we decentralize it as much as possible? We're aware that being an issuer is centralized. You can't really get around that, but you can still decentralize, split up, and manage the risks. So for us, there's 6 different user roles that come together for completing this process. You have connectors, disconnectors, tierers, auditors. There's also handlers and confiscators. So an auditor will come in, look at on and off chain logs, make sure everything's online, produce an audit on chain for everybody to go and see and have a look at. And that role is independent from the others played by a different third party. If audits do not complete successfully, there is a freeze upon the market. So that then incentivizes the connectors and disconnectors who bring assets in and out of the system to act accordingly and not cheat the system effectively, because there are repercussions. So we've applied these methodologies that exist within DeFi, incentivization, decentralization, to the tokenization stack. We believe that makes it a lot more transparent, handles risks a lot better, but also it means that then working with off-chain custody providers, multiple of them can plug in. There can be multiple connectors, there can be multiple disconnectors, there can be multiple custody offerings, so we can more create a network of institutions that can plug into this. Right now, 98, 96% of the market is all backed by a company called Alpaca, which is a US broker-dealer. And market access is limited to that. So we've got accounts at some tier 1 custody banks. I'm unsure if I can tout their names just yet. It's a long, slow process to get these accounts open. It's take about a year and a half. Yeah. Comms is equally just as hard to make sure you can get anything signed off. But we've got some tier 1 custody banks. We've also got some other tier 1 more market-making brokers who have wider market access. So we can now look at offering EU and Asian assets as well, becoming very shortly. So sort of more answering your point, how we've approached tokenization is to kind of create a tokenization network or tokenization layer where multiple participants and institutions can plug in to build a much more thorough and stronger base. The other great thing about setting it up like this is when interacting with a tier one bank, call it Citi, BNY Mellon, JP Morgan, just pick one of them, for example, they don't want assets leaving their custody. They don't want to send assets from them to Alpaca and lose their AUM. With us, we have an account inside their institution, and getting those assets on chain is as simple as doing an internal account transfer. So you can have large whales, LPs, market makers, individuals holding large amount of funds. You just do a simple internal account transfer into ours. You haven't had a taxable sale event. You haven't had to sell that 10 million of Tesla into fiat, get it into stables and rebuy. You've simply just moved it on chain within the institution that you're already working with. So lots of points there. Hopefully that answers your question.
Okay, for what I have understood, so essentially Stocks is building like a layer, like a meta layer, and on this meta layer there might be several entities can plug into it, can be connector, disconnector, therefore there are custodian, there are auditors that make sure that everything check the boxes. You have also certain collaboration with tier one bank, and if I have, for example, Stocks to in a tier one bank or a custodian, I might be able, so if it's already plugged in together with you guys, to keep her where they are, so not moving, whatever is the custodian here, and issuing directly the stocks on chain, and therefore I gain in fungibility, DeFi, and so on and so forth. Am I reading this correctly, in particular the last part?
Yes.
Okay, and this is a nice transition then to the next topic, to using tokenized stocks in DeFi, because I think that this is where become very interesting and also complex at the same time. I think that as of today, we're going to. It's not even a prediction. We are going to have stocks trading 24/7. So the question is, how do we get there, right? And consider your stocks are already trading 24/7. So what are the challenges that you are facing in order to, for example, make them trade during the not trading hours?
So a lot of pretty much all stock liquidity across any provider is mostly relying on the bridge. So connecting into TradFi liquidity when the market is open to bolster those markets, keep prices in line, and also gain more liquidity when required.
Mm-hmm.
It's quite easy to do that.
Yeah.
The issue comes overnight and over the weekend where you don't have a real North Star on where prices can just sort of wander in DeFi, and we'll just have to realign on the open on Monday. How we approach the risk is just increasing spreads. So if users want to trade overnight and over the weekend when there isn't the same access to liquidity, they will be paying a premium to do so, because on the liquidity provider's side, there is additional risk for providing liquidity at that time.
When you say increasing spread, it means that if I am, how do you increase spread? So in the liquidity pool, I'm paying a higher fee, or am I paying more premium? How will it work?
So we have another entity called T0, which does all the market making operations across stocks.
Mm-hmm.
How the sort of flow of liquidity currently works is we have our bridge, of which market makers gets a authorized participant status within, so they can move assets really quickly through the bridge. We have our order book, and then we have multiple different DEX venues beyond that: Aerodrome, Hydrex. We've also started setting up some Euler markets, so liquidity starts to dissipate through those places. How T0 handles market making operations within our order book is we take an oracle price and we simply run a spread around it. So when markets are open, that spread is quite minimal, something like 0.2%. And then when markets are closed, we increase them much more to something around 1%.
Okay. So is around 1%, or does it change for different stocks? Because maybe one stock is more volatile than another, or it's standard?
Exactly. It changes for different stocks. So for some of the larger ETFs, S&P 500, it's less. We've got SGov, which is a short-term treasury BlackRock ETF. So that hardly moves, right? It's basically a yield-bearing stable coin without the name of it, right? So spreads are even tighter on that. And spreads for us in T's area are currently moving quite a lot right now because it's currently a voyage of discovery on exactly what the sweet spot is for us at the moment. So we're constantly reassessing and updating the spreads that we hold for certain assets. And it can also be changing in terms of the volatility that we see in the market, and also inventory that we have at that point in time may cause spreads to go even further.
I see. Okay, interesting that you mentioned T0, because I was in a podcast with T0 a few weeks ago with Christopher Russell, so I didn't know that you were also collaborating. Very interesting. Okay. Well, clearly there is a complexity that you're managing at this point. Well, I personally believe that this will stop because the New York Stock Exchange, I will just, get on board with it, and it's gonna happen. But going one step forward, I think putting stocks in DeFi in general would also, and we already touched quickly on this specific topic, would also expose these stocks to potentially corporate actions. That, actually, talking with you guys, with your team, I learned that there are a bunch of stock corporate actions. And how do you make sure that the stocks can survive in DeFi when there are corporate actions like split, dividend, in particular, for example, if it is also collateral somewhere?
Sure. So yeah, there's a multitude of corporate actions, and a lot of our time was spent mapping all of those, seeing what actions occur off of those, and then what on-chain actions we need to do to make sure that markets can stay in line across lending protocols, AMMs, individual holders, so that nobody sort of loses out at any point in time. For dividends, how we've handled that is the tokenized version, then also the wrapped version. So with the tokenized, you get the cash sent directly to you. So we do a snapshot at the time of dividend payment, money goes out. For the wrapped version, it gets reinvested. So the price of the wrapped token will increase, and then across AMMs, lending protocols, there's no actual change in the amount of tokens that you hold, or you don't need to receive any cash into an additional place. Those tokens that are staked, held as collateral, just change in price themselves. So it's quite an easy way to do it, and I think we're the only ones at the moment providing you the choice to both. So if you prefer to have cash, simple, you'll do that, great. Because I think in the future there's going to be maybe a bit of an issue in 2 years, 3 years time, where users interacting in an interface will be like, well, I see Apple, the actual price is 300, but why is it saying 330, 360 here? It could be a major UX problem for individuals. There's also splits. So a stock can change the amount of shares that are in the market. They can double them, for example, so then the price would be halved. In the early days when we first started having some markets run and we weren't quite as on top of keeping on all these corporate actions, we had noticed like a day later that their split had got on. Luckily, there's only a few holders, people that we know. So the ways that we currently operate that at the moment is we have an oracle, and that oracle will say when a split has occurred and then how much tokens have changed, and lending protocols, AMMs, can act accordingly in line with that oracle. There's also mergers and acquisitions that go on as well. So in certain events, we can pause the market and then pay out or change users over to a new ticker as in line with the actions that are happening off chain as well. So it's a combination of tokenized and wrapped versions, oracles being able to tell different protocols how they need to rebase in line with splits, and then also being able to freeze the market and just handle things if there is like a weird, Apple buys out Tesla and they're all getting changed over to the Apple ticker on the 12th of June or something like that.
Okay, I see. Actually, it's interesting because I was thinking about the really the wrapping solution that we know, in DeFi since quite a while. So when you wrap the asset, then you do have a certain level of simplification, right? So if on the other hand, if the asset rebase, you have a lot of complexity. But my question for you is, on one side, I see that there's a very elegant solution. On the other side, are we not also fragmenting liquidity? Because at that point, we're going to have stocks, normal stocks, T stocks that pay dividends, and another one is a wrap version. So in essence, I do have two tokens that probably can move from one to another in a way. But are we not fragmenting liquidity in this case?
Yeah, so firstly, it's very easy to wrap and unwrap, and then secondly, all the distribution is the larger point. All the sort of on-chain distribution that we do, where we're trying to build liquidity across AMMs, lending protocols, and even the main base trading token, currently for the moment for us, is the wrapped version. So it's more of it's wrapped by default and a user's choice to unwrap. But yeah, it's very easy to unwrap and wrap. So in the UI, we could make it, you could buy it and swap. You could unwrap and buy it in the same button and not even realize, the difference that has been made. But yeah, when we're talking about pooling liquidity, trying to build up all of it across multiple different protocols, that's all done, and all our efforts are put into the wrapped token.
I get your point. It is like almost like the standard version. Okay, and you also mentioned, of course, merger and acquisition, stock split. If there is a specific stock split and the wrap token is in a lending market, what the lending market should do? Do they need to also freeze that specific market at the same time, or what is the standard procedure, the safer procedure?
So we use a lending market oracle adapter. So that's a pause-aware chainlink shaped wrapped over a live Pyth feed. And essentially what that will do is tell lenders when a corporate action has occurred. It will have an ID against it, and it will tell them the amount that they need to act when a split happens. So it's really on for the lending markets to build in line with this. There's, building for tokenization and RWA isn't just for the issuer. It's if lending markets, if other protocols want to accept this new asset class, which is growing rapidly across DeFi, they also as well need to build around it as well, because the splits can cause issues if not handled correctly.
I completely agree with you. And considering that also the lending market are using more and more real assets, that's something that they need to consider. Would you say that there is a different way to handle, for example, a corporate action across different token issuers? Because if this is the case, it means the lending market will need to comply to different standards in order to remain available, or in order to basically list as a collateral different type of stocks.
For sure. And I think this is part of the issue. Well, not part of the issue with Onchain, but you can see when people come up with standards and then there's 10 different standards of a standard and everybody's trying to push a certain way of doing things. We found a way of doing things that works for us, and we haven't had any problems with it yet, and we just continue to go in the same vein. We're also sort of leaning on the oracles to try push more of the standard. I feel like that's more of something that fits within their camp, because that is what the protocols rely on to get the information of what's happened, right? So Chainlink has been pushing quite hard into corporate action aware oracles. So yeah, we've had many conversations with them. Just yeah, it works for us. We're not trying to create an industry standard just yet. So yeah.
I see. And how, I mean, we have seen stocks, tokenized stocks becoming more and more important in DeFi world in general, as you stated, as a collateral, or in general, also real world assets a lot inside Aave. In hyperliquid, real world assets becoming one of the most important assets to be traded in terms of volume. So things are moving, right? And they're moving fast. What do you see are the next steps for stocks tokenization in the broader DeFi panorama?
I think it's all about trying to win on-chain liquidity.
Mm-hmm.
When looking at current solutions or competitors, when you go and look at the pools that they have set up, there's actually very limited liquidity and also across aggregators. Some of the aggregators that we're working with and discussing with, they highlight the problems of on-chain liquidity. And for us, we believe everything ends up on chain. We don't believe it ends up on a SEX. We don't believe it ends up on like a centralized thing that interacts with DeFi. We believe it's pure DeFi. So for us, we think the next sort of real unlock in this space is solving on-chain liquidity for this asset class, and something that we're head down building towards. And then the second thing is wider expansion of market access. As I mentioned before, I think it's something like 96% of the market is relying on Alpaca. Alpaca only have access to the US market. So very shortly with us, you'll see EU, Asian markets starting to open up. And I think that's one of the core benefits of being on chain, right? And the tokenization framework that we've created, we can connect to different institutions around the world, connect into all their liquidity, connect into all their market makers, and aggregate that on chain. So you're interacting on chain is sort of like a aggregator of all of these off-chain different institutions and pricings.
I was glad to hear to have more, I mean, having more markets, having access to more assets. It's great. About the liquidity, that's it's clearly an important challenge. How do you plan to tackle this challenge? So what kind of opportunities do you see in front of you to make sure these markets are more liquid on chain?
So the first thing that the team actually built, the engineering team that we partnered with to create stocks, the first thing that they built was Raindex, which is an intent-based bridge where each intent is a programmatic order which can be written in a language called Rainlang,
Mm-hmm.
which they created. It's like a spreadsheet style code where you can create anything you want. The reason I'm explaining this is we believe intents are very powerful for solving the liquidity issue around stocks. So we view liquidity in three separate tiers. So tier one, we call our blue chips. So that's liquidity in our order book, solved through our bridge, and also liquidity across Hydrex, Aerodrome, many other venues. So it becomes atomic, easy for people to interact with, and fairly deep across multiple venues. Tier two is solvable through our bridge, but we just have liquidity in our order book. So T0 will take a feed and put a spread around it with their own inventory, or any other market maker can do that as well. Tier three is no inventory on chain in our order book or in other venues, but still solvable through the bridge. So with that intent system, you can place an intent and have market makers see the order, see off-chain prices, interact with it, and directly interact through the bridge to access that liquidity. The limitation on that then becomes you can only do that when markets are open.
Mm-hmm.
However, it's a way that you can then easily scale to 10,000, 20,000, 50,000 different markets across multiple different jurisdictions quite easily because there's no requirement for liquidity and it can still work on chain.
The design that you are describing, it reminds me a little bit the design of cow swap, right? So intent based. And then there are entity like solvers that can get essentially the liquidity wherever they want as long as the intent is satisfied. Is it something on this line? Basically, if you give me the Tesla stocks, I'm happy, and whatever you get it, I'm happy too.
So our intent system is a more on-chain version of that system. So CalSwap, as I'm aware of it, will take orders and ping them to market makers in its sort of centralized order matching system and have them come back to them, and they will then facilitate that transaction in a central decision-making way. For us, an individual posts the order on chain. That order is backed by a smart contract itself. It can't be cheated. It can't be pushed in a different direction. There's no individual operator deciding where that order will go. Solvers, groups of many individuals, arbitragers, market makers scan the blockchains to look for arbitrage opportunities where they will see this order ping up, and they in the quickest way will find the best way to arbitrage it with the existing liquidity that exists on chain. So it's the same overall process. It's just that the decision making part is split from a centralized entity interacting with people in a Web2 format, pinging information back and forth, to a intent that is expressed on chain, which solvers have to listen for that on-chain action to then facilitate on. So it's a lot more secure, a lot more on-chain decentralized version of it. We have solvers clearing on our market who we don't even know who they are, right? So people can just pick up on these orders. There's millions of dollar infrastructure out there that has been deployed into creating the best solvers, scanning the market, finding these opportunities and executing on them. And they're picking up on our market. We don't even know who they are.
Okay. So the majority of the structure is completely on chain. So does it mean that, for example, let's assume that it's not a blue chips, it's a more exotic asset that you have tokenized already, and it's on chain, and there is an order. There is not enough liquidity in your own book, so you cannot fill it directly. As I understood, there is not enough also liquidity on the friendly market maker that you have. In this case, it's zero. If there is another solver that should pick up this order for these whatever Alessio stocks, right?
Yeah.
Where can he find it? Because you say that he needs to operate on chain, so he will scan every chain to see if there is a my stocks or a version of my stocks, but he will not go to another broker to find the stocks. So can you clarify this part?
Yeah. So for people to solve our intents through our bridge, they need to be an authorized participant within our bridge. So they are then a known party to do that type of solving. The solving I was referencing to when we have people who we don't know is when we have liquidity in our order book and other venues, Hydrex, Aerodrome. Those are the times when we have solvers come in and we don't even know who they are. They're just seeing the liquidity, they're seeing the mismatch in price, and they're just executing the orders.
Yeah, clear. Okay, but in case let's say another possible solver, where can he can find these tokenized stocks in order to fill the order? So what option does he have in order to fill it?
So we have pools on Aerodrome and Hydrex. So those are the two main other arbitrage points.
Okay, I understood. Regarding, I was looking into, I learned, and I was pretty happy at some point, that finally the stocks volume on Solana crossed for the first time the meme coin volume, right? Sorry for the meme coin lover, but I'm much more a lover of real world assets. And when I was studying it, I saw a lot of volume from X stocks, Backpack, and so on and so forth. But also, I realized that the majority of the tokenized stocks volume is on Solana, right? So why do you think this is happening? They just are winning the race one more time. So what's your analysis of this concentration of specifically stocks on Solana?
Yeah, I think Solana has done incredibly well for gaining a user base. So they in the meme coin run, they attracted a lot of traders, a lot of individuals who use the platform. As with anybody, I'm sure it's the same for you and I. We have our wallets, we have our chains, we interact on there. I bridge, but it's easy just to use what's there, right? And Solana has definitely got that user lock-in with diehard fans of Solana, and then also those that just that's where their money's sat, and they can just interact there, and it's easy for them to do so. But I think we're a huge believer in EVM. Everything that we've built is across EVM. There's a whole industry across multiple different chains continuing to build better solutions, and we're seeing Ethereum just get better and better. And I think across multiple different chains, what we are seeing is a sort of dying off of L2s, where they've sort of realized that, right, there's not a huge amount of value that we could have added here. Other specific chains as well, some of the older ones are turning into zombie chains. They're really struggling to try get users, and then you also have other chains which aren't completely neutral in who they interact with, right? A lot of exchange chains pick their favorites, and they want those to win. Ethereum is great in that angle because it is completely neutral. There is no favorites. Huge amounts of, it's still the winner in value that sits there. Institutions know it. They're comfortable with EVM. There's a lot more developers around there, and we believe that that's where the future is going to go. Solana got a bit of a win because it was fast, and it still is fast, right? But Ethereum is going to get faster.
Okay, I like. I mean, I think it's a very sober analysis, right? So they had already traders. I mean, the retailers were already there, but on the other hand, a lot of institutions and also big financial distributors, they are deciding for more EVM solutions, even if they launch their L2 or the kind of L1 based still EVM. So you would what type of let's say clients would you see as the possible best clients for the stocks, but as an issuer, ST0 issuer?
So S1 Issuer, the best clients that we currently have at the moment are institutions that want to dip their toe in the water. They want to start testing, they want to start experimenting. Maybe they're from a different asset class, and they have size that can really move a needle in a small test. Where a test for these institutions can can blow some of the TVL that we have already out the water, right? So they're a great use case. They see the value in what we're building across stocks as well. So building out the stocks trading side, the on-chain distribution, proving that we can set this order book up, have liquidity dissipate across different venues, have lending markets, proving all of that with stocks then makes S1's issuer more attractive because you can see that it's being done. You can see there's a team that working there and how to do it. So yeah, that ideal client is those large institutions that wants to start understanding this technology and start testing with it.
Yeah. Okay, but let's say that tomorrow large institutions will use your infrastructure to tokenize, let's say Apple stocks. And then you have your Apple stocks, right? Your own Apple stocks. Will it be a sort of fungibility between these two? Meaning they're kind of equivalent because they share the same infrastructure and potentially they can also share also some liquidity, or it's something that you might explore in the future?
So we haven't actually yet had any customer come to us and say they want to tokenize publicly traded assets. And some partners who have expressed interest in doing that, we've pushed them down the angle of, well, we've spent the last 2 years creating this infrastructure, liquidity. We don't want fragmentation. It's a lot easier and better for you just to use the existing solutions that we have. And then we've turned customers of S1 Issuer or interest into that to then integrators of stocks and our markets. So yeah, the customers of S1 Issuer are very different to the assets that we're offering on stocks.
All right. And what if large institutions come to you guys and say, look, I want to issue these assets. For example, I want to issue Apple stocks. But I want to have it in my walled garden. Why? Because whatever I'm using, I'm trading with other institutions, so we want to have our own infrastructure with KYC, KYB compliance. Would you also will your infrastructure able to serve this type of needs where compliance is one of the primary objective?
Yeah, exactly. And we can already do that today in our infrastructure. If an institution wants to go down that route, and I can understand the reasons for them wanting to do that, we can support and facilitate that. For stocks, we see public markets being open, we see them being accessible, we see them being a public good. We understand the need for KYC and AML at the perimeter. So on ramps, off ramps, when people are actually moving money in and out, there still needs to be some interaction. But when you're interacting on chain as an individual wallet in a public market, that's where we really see the future going, when a developer or a protocol could simply just build on top of something without asking permission. That's where we see things winning. And I think we can see that playing out in real time, right? We're starting to see more institutions interact. We're starting to see openness to interacting into DeFi. And the private and permissioned chains that I think was a bit of, private permissioned L2s, a couple of them popped up. There's been no real major success within there. I'd say the only outlier is Canton.
Yeah,
However, yeah, but I've spoken to a couple, we've spoken to them, we've spoken to people that are building on their chain. What they have done is incredible, amazing. They've built a great solution. However, it's extremely restrictive, right? So any change in a smart contract has to actually be authorized before it can be put on there for anybody to interact with. And as I understand it, they're trying to make their blockchain more scalable for handling larger volumes, and it's an issue that they're currently facing. But yeah, we believe in public open markets. We believe markets should be a public good and people should be free to interact.
I see. And how do you see in general the future of real world assets? I think we've been zooming in a lot on stocks, but you also explained it as your infrastructure is very versatile, so it might apply even to real estate potentially. So how do you see the future of real world assets? What type of real world assets will come on chain faster than others? What will be used in DeFi? What will not be? What's the future? How does it look like? Show our crystal ball.
Well, I think my guess is I think right now everybody in crypto is making solutions for people in crypto. And that's true for these markets. When you look at stocks growth, on chain, the TVL increasing, it's mostly going to service sexes, different protocols, and wallets for the users interacting there. Where we would like to get to as our own company in the future is being able to service Web2s, banks, standard fintechs, and say, look, on-chain doesn't matter. All you need to know is that this is a highly secure system that you can interact with, trade 24/7 fractionally with great market access, completely secure, and we can't get in the way and muddle with it and do all these dodgy things that could be possible in Web2. And that's where I would like to get to. That's where I'd like crypto as a whole to get to, and not have these barriers of interaction. On and off ramps I think they need to come down in price drastically to make that possible. Some of them are still charging 2%, which for investing in the S&P, which moves 11%, is not feasible at all, right? So I see that as the main barrier. I think that's as a problem as a whole that crypto needs to solve, not the individual issuers of tokenized assets. But I think, yeah, we just continue to see stock trading increase until there's a huge influx of liquidity. Everybody's risk appetite increases massively, and then they're all interested in trading meme coins again, and volatility's through the roof. But until then, people are probably going to be interested in real companies solving massive problems, making billions of dollars, which is an interesting thing, because back in 2017, 2021 run, I didn't feel like we had that in the TradFi space as much, right? AI wasn't quite popping off as much. The advancements that we've seen in biotech recently have been crazy. We're now starting to see small nuclear reactors be put in place, and what is happening in TradFi is very compelling right now. I can understand investors changing heads and direction because it's quite in 2021, 2017, it was like, yeah, there was some Apple's made more money this year selling more iPhones. Google's come out with a new version of Google Maps. It wasn't quite as fast changing as the space is now.
Yeah, on one side we lost a little bit of spotlight, right? There are other things that are the new cool kid, in the neighborhood, like AI. But on the other hand, I think that we do have probably more usage of blockchain technology today than in any other people in our history, right? So
Yeah.
any other point in our history, right? So I think that it's good, and I think that your vision is pretty solid. So meaning, if I can summarize it in a way, that stocks want to become, or S1, more the infrastructure, the plumbing, of many fintech that, for example, want to have 24/7 trading of stocks, right? And if you have this system that is very efficient, in auditable and incorruptible, that it's a great thing to have. Okay, so I have seen as an additional point, I was looking at some of your pool. I've seen some great APR here. I mean, obviously not financial advice, but I am a long-term lover of liquidity pool, in particular in decentralized exchange. So I think most of the pair are stocks, USDC, right? But I've seen also, for example, MicroStrategy, Bitcoin, right? So where do you see the biggest opportunity in your infrastructure right now?
So to explain a little bit more about this APR, what we do is we set up pools on other venues. So Hydrex and Aerodrome on Base. We set pools up with them, and if you LP in those pools, you get a yield back. That yield comes from two sources. One, the trading fees that happen on that pool, and then two, right now we are also incentivizing it. So you're getting a bit of an extra kick. Depending on the investor, there's different returns. So if you look at the S&P 500, let me just see if I can get it up right now. The APR on it, SPYM. So we have a 15% APR right now on SPYM, which is our S&P 500 ETF. That 15% APR is higher than the yearly average of the S&P 500, which does, I think, around 11%. So you can LP in this pool and get the amazing returns that it does anyway, with the compressed volatility that it has. It's not as volatile as meme coins or anything like that. Plus, get a APR return on top of that vastly beats anything that it historically does. We also have on SpaceX, I think right now the LP reward is 250%, which is crazy. On MSTR, there's an APR of 30%. Me personally, I'm in the Bitcoin and MSTR pool. I quite like the position of slowly moving some of my Bitcoin into MicroStrategy, because when it goes up, you get a slightly levered effect. And I'm thinking that with that extra APR, I can sort of offset any of that additional downside leverage that I would be getting at the moment with exposure to MSTR, plus getting the fees on the pool. So it's a super interesting time when these assets are now available, but also usable in DeFi and can get some of that DeFi payout and incentives as well.
Sounds great. But what are the incentives? You say that on one side there are classical fee, and on the other side you're also incentivize this pool. But where does incentives come from? It's like a few is USDC, is Ethereum, what is it?
So we put USDC into the pools, and then across Aerodrome, I think the processes are a little bit different, but essentially Hydrex and Aerodrome vote where emissions can go to, and then what we top up plus that gets paid out to the users. Long story short, it's effectively coming from us. It's like a bonus period that we're running with trying to increase liquidity for these stocks on chain. And it's a great time for users, not investment advice. I'm not soliciting you to trade whatsoever, but it's a great time to do so. In brackets.
Vibes mechanism. That's what you're describing. All right.
Yes. Yeah.
All right. Cool. Okay. Well, super interesting. We'll look into it a little bit more in detail. Also, I believe that there is a certain correlation between MicroStrategy and Bitcoin. Therefore, you might have even less impairment loss, I guess, maybe. Need to check it out. All right. So we are getting closer to the end of this great conversation with you. And I would like to know if people want to get in touch with you or with stocks in general, they want to partner up with you. What is the best way to do that? Consider we'll also put the links in our comments. But in general, are you more active on Twitter, on Telegram? They just need to ping you via the website. How would it work?
So the best way is if you go to our Twitter, you should see a link to join our community. There's around 600 people in there. We very much on purpose try to keep it a no spam environment with no bots. We don't have any agents in there creating communication. It's just really users asking questions. So just jump in there, ask whatever you want. You can also DM me directly and you'll see my name popping up there regularly. So that's the best way.
Okay, well, fantastic. So it has been great having this chat with you, and we'll invite you again to check in the future. We'll see if our predictions were correct. We'll see how the future of tokenized stocks is evolving on chain. And thanks again for this super interesting conversation.